This is LONGWave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, October the 7th, 2015. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intention to keep the technical analysis charts to the subscribers' report so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term confidence and sentiment. This month I'd like to cover a range of topics listed here that I think are becoming extremely critical. And I'd like to start with a discussion on Glencore, who have been in the press and the media lately as really a canary in the coal mine. It's a much bigger situation than is currently getting coverage on. I'd like to talk about the continuing dismal regional Fed reports we're seeing, what it means, problems in the credit investor, credit markets, and some key warnings that have been showing themselves. Of course, what I expect going forward. Last month, I laid out that we were in the midst of a revenue recession and an increasingly dramatic global slowdown in trade. Q2 marked the first time the S&P 500 index had seen 2 consecutive quarters of year-over-year revenue decline since Q2 of 2009 and Q3 of 2009. The blended revenue decline, according to FactSet for Q2 2015, was a negative 3.4%. Things have gotten even worse as we close out Q3. We now have a U.S. manufacturing recession in addition. We are now likely in a U.S. profit recession and can expect the current earnings season to bring this out clearly. The markets are already on heightened alert of this pending news. Of course, this starts to beg the question of whether a U.S. recession in 2016 is a real possibility, an economic recession. If the Fed had raised rates at the September FOMC meeting, then it would most likely have locked that expectation in. It delayed raising rates, and forecasters like Goldman are now talking about late 2016 before this is likely. How quickly things change. The global economy is in trouble, and the Fed and the central bankers are now painfully aware of this and are starting to signal it, as you heard in Janet Yellen's press conference after the FOMC meeting. We have felt since the announcement by the U.S. Federal Reserve of its taper program that an inevitable collapsing commodity market in emerging economies would be the catalyst for the next crisis. We concluded in our thesis paper, The Globalization Trap, the good proxy for a slowing China would initially be commodity prices, and in turn the leveraged players behind the massive commodity run-up that was supporting the China export machine. Make no mistake about it, China is in the process of a hard landing, which is being once again temporarily camouflaged by credit expansion in China. Buying the credit default swaps of commodity trading giant Glencore has been an ideal way to trade the Chinese hard landing, and there is a lot we can learn from Glencore about how the current environment will likely unfold. Glencore is currently the commodity trading firm getting most of the press because it is a highly levered player in a highly levered industry tied to a highly levered China. Be aware, however, that it could just as easily have been the Vitale Group, Trafigura, Gonvor, Mercura, Louis Dreyfus Commodities, Noble Agra, and the list goes on and on. That group I just mentioned alone has recently raised at least $125 billion of debt. Why? What is the panic to increase already dramatic debt levels? Liquidity, but we'll talk more about that. You must appreciate that Glencore, for example, is first and foremost a trading desk, which serves as a counterparty with trillions in derivatives notional exposure to virtually every other commodity using and trading entity in the world. Why is Glencore's investment grade rating so critical? Glencore is really not so much the Lehman as the AIG of the commodity world. With an investment grade rating, a self-reinforcing collapse will begin that could ultimately terminate Glencore's trading desk in the process of liquidating one of the world's biggest commodity trading counterparties. The short story is if and when Glencore loses its investment grade rating, its more or less game is over. If not for the company's already shuttered mining operation, then certainly for its trading group, where having its bonds rated as junk level would lead to numerous collateral shortfalls and margin call waterfalls, reminiscent of the ratings agency downgrade of AIG that culminated with the U.S. bailout of the insurer. As I mentioned, commodity traders have raised at least $125 billion of debt, of which about $75 billion is in loans. In other words, there's about, if you look at it, $75 billion in secured debt collateralized by either inventory and or receivables collateral, whose value has cratered in the past year, and as a result, the loan-to-value on the secured loans has soared. It is this that is prompting the panicked banks to be more eager to provide funds to the suddenly distressed energy trading sector than even the borrowers themselves. And you have to understand how, for the banks, in for a nickel, in for a dime. They have a lot to lose here. As Zero Hedge recently reported, one of the more unmentionable conspiracy theories surrounding the demise of Lehman Brothers in 2008 is that this shocking event was in fact a well-choreographed and carefully scripted controlled demolition. With the Lehman bankruptcy, the event that officially unleashed the great financial crisis, getting the express prior permission of both Ben Bernanke and Hank Paulson, a former Goldman CEO, whose motive was the elimination of the one firm that was then Goldman's biggest competitor in the FICC space and whose subsequent bailout of his former employer, Goldman Sachs and all other insolvent banks, would lead to the preservation of trillions in worthless equity courtesy of the biggest taxpayer-funded bailout in history, and with billions in excess reserve parked on Goldman's balance sheet, smoothing the bank's transition through a historic recession. Fast forward to the recent surge in its credit default swaps at Glencore, a potential doomsday scenario for Glencore is now on the table because the market suddenly realized that Glencore's most valuable asset is not its mines or its trading operations, but its investment grade rating, which could be stripped away. If the company is downgraded from an investment grade to junk, it's already been downgraded, but it's still investment grade. Watch as the commodity Lehman scenario for Glencore, which is much more than a simple copper miner, as I've mentioned, just happens to be one of the world's biggest commodity trading desks, comes full circle, leading to a waterfall collateral liquidations and counterparty freeze-outs, as suddenly the world is reminded that there is a vast difference between a real and a rehypothecated commodity, and that all collateral rehypothecation chains are only as strong as the weakest counterparty. And just for those who haven't listened to previous tapes, rehypothecation is pyramiding collateral, where it's used multiple times. Instead of when you pledge a car as collateral, the car is being pledged, an example, many, many times to support debt behind the scene. Goldman released a report, which is essentially a blueprint for not only how to take away Glencore's precious investment-grade rating, but taken a few steps further, how to unleash this cycle's commodity Lehman event, and taken to the extreme, how to force the Fed to finally unleash the helicopter money should Glencore's failure be the catalyst that pushes the entire world into a deflationary recession, if not outright depression. Goldman said in a note titled, "Much progress made, but the song remains the same," and I quote, "We update our estimates for Glencore following the completion of its equity placement on September the 16th, in which it raised its target $2.5 billion. We also update our estimates to incorporate our commodity analysts' lower coal forecasts and lower thermal coal forecasts, which impacts Glencore. Glencore has a few levers left, further lowering capex, signing streaming deals, and releasing more working capital. This would, however, take time. Glencore's trading business relies heavily on short-term credit. Remember this during the 2008 financial crisis and the shadow banking? It was about borrowing short and lending long. So they borrow short and you're using it to finance commodity deals, and which are long-term. And its financing costs would increase if it were to lose its investment-grade credit rating. In addition, it could even lose some counterparties due to increasing counterparty risk. What a junking of Glencore would do is start a collateral demand waterfall cascade that the cash-strapped company simply would not be able to sustain. Goldman explains what it would take for the investment-grade trap to shut. It would only take a 5% fall in spot commodity prices for concerns about its credit rating to resurface. 5%. That's almost literally daily swings in some cases. Goldman's straw man for the next mega bailout goes roughly as laid out here. Commodity prices drop that 5%, and then it just falls through these various steps. And it's ugly. Stay tuned, though, because things are going to get out of control fast, not just because of Glencore. Analysts are starting to come to conclusions that we've been writing about since at least this time last year. U.S. factory orders have only been this bad during periods that were later labeled as recessions, economic recessions. The regional Fed reports haven't been this bad since the last recession. I showed the manufacturing recession earlier, but here is a correlation that you should be aware of, and that is with forward earnings per share. There's an earnings recession coming, if it's not already here. The October non-farm payrolls were a surprise, but shouldn't have been. The regional Fed survey suggested we shouldn't have been expecting anything else, frankly. Historical parallels just can't be ignored by the markets forever. The data is becoming just too great to keep on spinning on a monthly basis. When you look at the oil consumption and global growth, the headwind the U.S. is facing becomes much more apparent. It's only a matter of time, and we're clearly seeing that now, before the global slowdown and the magnitude of it will take away any possible minor recovery that we're in the United States. What we must fully appreciate is that there are three cycles that work in concert. The business cycle, which everybody pays attention to, sort of. The rate cycle, maybe just one more of the Fed actions, but not necessarily as closely watched, though it has been recently. In general. But then the third is the credit cycle, which nobody seems to pay attention to. It is our assessment that the credit cycle has turned. Currency and credit markets lead. Bonds follow, and equities usually are suddenly impacted. Equity direction changes in an unexpected manner. For those watching the cycles and the other markets, it isn't that the equity market's direction changed, but rather more a matter of how long it was delayed and the timing of it. The growth in high-yield bonds held by ETFs has been nothing short of spectacular. This is a relatively new development in the last 10 years. The high-yield market was previously not readily available to the general public. It was the purview of the professionals. Now it is for traders, speculators, mutual funds, and anybody else searching for yield and capital appreciation based on sustained quantitative easing and ZIRP. But what happens if this reverses, or there's a fear of a reversal, or a minor correction? Is there sufficient liquidity for these ETFs to actually unload their bonds? Who would be the buyers, and at what price? We're talking about massive volumes here. This is the proverbial someone shouting fire in a theater with only one exit. It's never been tested. This is a new development, and something is going to shock the world in this area at some point. Global credit stress is intensifying. Yields are climbing dramatically, as are the spreads. Global risk appetite is falling and is at levels last seen approaching major market-moving shocks. These are worrying signals. The credit default swaps for high yield has been signaling a problem for quite some time now and has been very, very clear, and we've talked about that. And you can see that now showing up in this mix of commodity traders that I mentioned earlier. It isn't just in high yields. It's also in the investment-grade corporate bonds, which are now showing. Something is looming. Something is coming, and it's not too far away. We've pointed out the extensive list of prominent market experts that are now considered Cassandras. We've been listing them in the growing list in our quarterly meta document when we discuss risk in a lot more detail. It is worth noting, however, when a market veteran like Carl Icahn comes out as strong and as forceful as he has, you have to pay attention. Carl Icahn points out many of the issues, but pay particular attention to points number 5 and 7 on his list. Ultra-low interest rates are fueling asset bubbles and threatening to trigger another financial crisis. He's a major investor. Do you think he's investing now? Do you think he's trying to take advantage of this that the markets are going to continue to rise? Doubtful. Low-rated bonds are almost certain to collapse. I think we just talked about that. Liquidity is an illusion, he states. And I agree with that, actually. If interest rates begin to rise or economic conditions begin to deteriorate, especially in the credit markets, investors may find themselves in a situation where the markets cease to function. This happens time and time again in a crisis. That means that investors may find themselves in a position where they cannot sell at any price. That's when the low interest rate party bus goes off a cliff, and when a large cash position will become invaluable. Don't be lulled by the counter rally we have seen since the September FOMC meeting, after the frightening kind of numbers we saw in late August and early September. These bear market counter rallies ensure both the bulls and the bears lose the maximum possible. And it's the same pattern in any kind of major sell-off. I'm showing the 1929 counter rally before things got worse fast. Something starts to break the market. Everybody kind of poo-poos it. It rallies a little bit. And then suddenly the reality sets in and the market panics. How can we believe the U.S. economy is in a real recovery or things are going to get better when we see this sort of major trend? People are leaving the workforce with the only thing growing, at least until recently when the government cut it back, is food stamp participants. In the Great Depression, it was called food kitchens, and there were less than 20 million turning out at food kitchens. Today, we have north of 50 million on food stamps. That's a lot of kitchens. A measurement I watch closely is deterioration in margin debt. It comes about when credit tightens, markets become tumultuous, and margin is excessive. Market downdrafts usually lag margin fall off by about 2 to 4 months. And that's the area we're starting to get into now. As I said last month, we believe the real deflation leg is now well underway. It has been clear in the commodity markets since the beginning of taper. It has only recently become evident to the U.S. equity markets. When the Fed is forced into quantitative easing, helicopter money, and collateral guarantees, we can expect real elevated inflation and the strong possibility of eventually seeing hyperinflation. As I'm apt to keep saying, never forget, hyperinflation is a currency event which explodes prices higher as confidence in the currency falls and is lost. It will be about lost confidence in the U.S. dollar or possibly the replacement of the U.S. dollar as the dominant global currency during a de-dollarization event. Let me reiterate, I continue to fully expect a Minsky melt up before all this ends very badly sometime in 2016. Eventually it will be clear to all that the central bank policies have been a failure. The government's policies of financial repression are becoming just too heavy-handed as productivity falls, high-paying jobs disappear, and tapped-out consumer demand steadily slows. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2015 be an outstanding investment year for you.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.